There's two main investing styles. I want to talk about this today. Mitigating risk with the funds you buy, like SCHD and JEPQ. We're talking dividend investing. And then the other form of investing is maximizing return on investment with funds like Misty and Nvidia. This is Mike, tactical stock scalper. All right. Those are the two major forms of dividend investing of styles: mitigating risk, maximizing return on investment. And they're two totally different styles. So let's start here with mitigating risk. What does that mean? What does that look like? Well, mitigating risk with the funds you buy includes stuff like SCHD maybe, JEPQ maybe, things like that will hold your capital, pay you a small dividend, give you some share price appreciation, but overall, remain relatively stable. And it takes a long time to get your return on investment paid off. And then the other style, which is something where you're trying to maximize return on investment with funds like Nvidia and Misty. Now, the benefit to mitigating risk style is you're almost assuredly, nothing's given in a stock market, granted, but you're almost assuredly to retain your initial principal, to let that build over time, and the risk is relatively low that you will lose capital over time, right? We know the market goes up and goes down for a while, goes up and all that, but not talking about normal market cycles, just in general. Now, when you step into the realm of investing, trying to maximize return on investment, there's more risk associated with that because it's not the other style that's basically built to mitigate the risk of dividend investing. There's nothing wrong with either style. There's white knights on both sides. On the SCHD side, I'm just lumping all that into one, right? And then the high yield side, right? And you have white knights on both sides tell you that you're wrong for investing your money the way you want to invest it for what's best for you and your family. Now, for me, I started off looking at mitigating risk 2, 3, 4 years ago of getting into things like SCHD and JEPQ, stuff like that, right? And I thought that's the way I should go. I knew it would take a very long time to get my return on investment, but I liked the mitigating risk factor of that style of dividend investing. However, when high yield funds came out, I recognized that there's a chance, right, to maximize return on investment much quicker. And that fit what we needed in our family for our lifestyle. So I took that risk, right? And I'll get more back into the mitigating risk funds and how I will use those in the future. Now, I'm so glad I took that risk to maximize return on investment. And I'm sure a lot of people are. Like Nvidia, just for instance, SCHD right now, or since Nvidia came out, is up 28%. You're still going to have to pay taxes on the SCHD, etc., right? But the Nvidia is at 222%. Your return on investment, this is at inception of Nvidia, mind you, and reinvesting dividends. But hear me out. It's paid for itself twice over now. And the price is still above inception price of $20. So for me, this was a no-brainer way to go because maximizing return on investment was extremely important to us because I wanted all that profit afterwards. So yeah, maximizing return on investment was the best way for us at that time. Now, I'm not to my ROI on Nvidia yet, but I'm getting there. Middle of next year, or middle of this year, I will have it. But I will move, once that comes to fruition, of maximizing revenue on the VIDI after the initial investment's paid off, I will then move into things like JEPQ, SCHD, but I need to wait for a major pullback or correction even before I dip my toe in those, because for me, it doesn't make sense to buy something that pays such a small dividend and takes so long to maximize return on investment when the market keeps ripping up. Okay, so for me, it makes sense to wait for a market correction or down year. That way I can maximize the, what do we call it? The mitigating risk funds as they go up in share price after a large decline. Because we know that's going to be an issue with high yield funds, right? That's another thing that you have to understand is like when if there is a down year, months, whatever, the upside will be capped. And so the upside won't be as capped as hard on the mitigating risk funds on the way up. So I will be able to pull 100% of the dividends, and it won't affect my cost basis. It won't affect my initial investment at all, because it's always above my cost basis. I'm not hurting myself by doing that. So that's how I'm going to factor in and use the mitigating risk funds after, well, or close to, when the return on investment is paid off on my maximizing return on investment funds. Now, to maximize your return on investment, you can't keep pouring money into it. At some point, you have to stop so the fund can actually work, so it can actually start paying off your investments. You keep adding money into a fund that you're trying to get return on investment on, you just keep widening the goalposts, and it's going to take a longer period of time. So that's something to consider. If you really want to work on ROI, quit putting your own money into it. Let that fund start working. And if you're in the building stage of your account, maybe you start on another fund, right? So use the one, you have your share count, your money count, whatever you want to use, cap it, you're done with it, you're done putting your own money into it. Now you're going to move on to another fund while that one does all the work on maximizing return on investment. I know it's weird to say, and I'm going to repeat this again. There's nothing wrong with either style. Nothing absolutely at all. It totally depends upon what your needs are. Don't listen to people on social media telling you your way is wrong because they don't know your lifestyle. They don't know what you're trying to achieve, right? Everyone wants to save you from taking way too long with SCHD to get ROI, or save you from losing all your money trying to maximize ROI, when both sides are wrong and right at the same time. You got to do what's best for you. I just chose to maximize ROI before mitigating risk. So Mike, Tactical Stock Scalper, out.